Hi, this is Dave with Market Trading Concepts. It is Saturday, May the 12th, closing out the week for Friday, May the 11th. This will probably be the last video I do with this microphone. I think it's time to get a new one. So I apologize if there's any audio issues with this recording. Let's start off the analysis for the weekly market recap with the Dow Futures. The Dow Futures, we talked about last week. What I thought was going to happen was I thought we were going to push to new highs. So what I was looking at here was originally we had this wedge pattern here. Okay, we had this wedge pattern. We had what I thought was a bit of a fake out where it came back down here and tested support, and then it pushed to the high side and it retested these highs. Now usually what happens, and I mean that is what played out. So last week we had a test of these highs at around 13,242ish, around that level. We actually broke above these highs all the way up to the 261 level, and that was potentially just a minor stop run, which could explain why we had a little bit of movement. It was only about I guess about 20 ticks of movement above this level. I would have expected a much bigger blow off to the high side, because a lot of people that are short would have had their stops somewhere in this level. So fast forward to this week. What I thought was going to happen initially, finishing off the analysis from last week, was once when you knock on resistance's door so many times, or you knock on support's door so many times, usually you're going to get a move one way or the other. But what's ended up happening was I was expecting a pullback and a push higher. Now we didn't really get that, did we? What we're really dealing with is this huge, you could almost treat this as a huge Darvis box now at this point in time, and it's really a huge dead zone. This entire range is just a huge dead zone. If you look at it from a swing trading basis. Now if you're intraday trading this, it's not a problem. You can usually catch decent intraday trends. Like for example, this move on this day would have been a good day to the downside that you could intraday trade it. You could day trade it and grab shorts on the way down, and that way it's good to kind of round out your trading if you can swing trade and day trade, time permitting. It gives you the flexibility. It gives you the flexibility of being able to catch intraday trends as well as as well as the larger swing trends. Now, in my opinion, right now this entire area is the dead zone from this high to this low at this point in time, and what I'm really looking at is not a very good swing trading environment. Now we're always expecting the markets to be trending, and that was great when we were in and around this area. If we go back, when you start trending, these are sometimes they're the easiest areas to trade, because you're just buying pullbacks. You buy a pullback, you buy a pullback, you buy a pullback, and the expectation is that you're going to resume the trend higher, right? You're going to resume the trend higher. So when you catch, you don't catch, let's say, the low, and you don't catch necessarily the high, but what you do is you catch the meat of the move in the middle, and those are usually the easier markets to trade from a swing trading basis. Now when you get into a situation where you now are going sideways, this is a tougher area to trade, because what you're really experiencing here is would appear to be a tug of war between the longs and the shorts. You're not going higher, you're not going lower, you're just stuck in this dead zone. So if you really look at this, what we talked about last week, I mentioned that I wasn't really interested on the short side at this point in time because it was against the trend, and I was talking about specifically these support levels, 12,800 in the Dow Future, 12,652. And what I was saying is that I wouldn't really be interested in a swing short unless we broke this level decisively and ultimately broke this level decisively. You can see there's a lot of support at this point in time at these levels. Now anything can change this. Anything can change this going into the future. If you get a huge geopolitical event or you just get a change in market perception, you could have a situation where we just sell off from here. Now what I'm really looking at is this 12,800 level. You can see how many times it tested this level, 1, 2, 3, 4, 5, and we really were trapped in between, you know, for the latter part of the week in between these levels. And it always, you know, your median level was this 12,800 level. This level is a huge, at this point, a huge support level, and the market is holding on for dear life at this level. You can see it probes above it, you know, resistance, it probes below it. You do have some support down here, but it hasn't yet come back down and tested this support. So this is the level in play right now, 12,800. And when I mean the level in play, I mean you can see that you can get 50 to 100 ticks above and below that level, but ultimately you can see where all the opens and closes happen. They happen right above this level. Now the market closed on Friday just below, like maybe 20 ticks below this level. You know what I mean? It closed about 20 ticks below that level, which is basically at that level if you look at it on this type of time frame. So what I'm looking at going into next week is I put the 8 EMA on here. This is the yellow line. I've got the 8 EMA on here, and what I'm looking at is I wanted to see, okay, we had it cross over here and then it came right back up. But now what it's starting to look like, now it's starting to look like almost like a double top, right? So this almost looks like you know, you've got a double top in play here. Now patterns work great until they fail. So what you would really need to do is in order for this pattern to be a double top, you'd need it to follow through beyond this level here. You'd need a clean break of this level, and then what I'd be looking at is a retest, a confirmation of failure, and then looking like it's going to you know, sell off and follow through. What you really want to see is the follow through from the level, or the follow through from the pattern. Now one of the things that I'm noticing more and more, and it's one of the ways that I look at trading, is most professional traders, in my opinion, and by professionals I also mean, you know, the banks, the big institutions, the real money in the market, they look at key levels and they usually look to take positions at key support and resistance levels. So what I would expect is that they would be watching, for example, a level like this for failure, and then looking to see, you know, looking to see if it's going to work. So for example, if you take a level at a key support or resistance, if you take a trade rather at a key support and resistance level, it's going to work out pretty quickly, or you're going to know that it's not. Like for example, if we fail this level and we come back up and retest it, and then somebody, let's say a big institution, initiated a level here, a short, they could place their stops within a reasonable amount, or they could manage their trade and say, look, if it doesn't break above this level again, then, you know, this is the side we're on. We've got our risk contained, you know, close to this level, and it's either going to work or it's not going to work. The other way that they could look at this is they could say, okay, you know what, we don't know which way it's going to go from here, so let's sell it if it gets below there, and let's buy it again if it gets above there. You know, almost like a bracket order, or you know, similar to the way I treat, you know, Darvis box breakout type trades, where, you know, these levels will confirm the direction. You know, you don't even really think about it. You've just identified the key support or resistance level, and you just go with it. If it confirms weakness, or if it confirms strength above that key level. I'm pretty sure a lot of institutions do this. It makes a lot of sense. I've been reading a really good book that was recommended by one of the members of the room here, Jason, and it's called Way of the Turtle. And Way of the Turtle was a book that was written by one of the original turtle traders. They were a group of people that resulted from a bet between two large traders who were friends, and basically what happened was they were betting whether traders could be trained or if it was some other inherent quality that made a trader. And Richard Dennis suggested that traders could be trained, and Bill Eckhart felt that they could not be. So this book was written by, I believe it was the top turtle trader. His name is, I believe, Curtis Faith. And he wrote this book, and one of the things when he talks about the psychology of support and resistance, he's talking about, and I don't mean to butcher his explanation, or, you know, it's worth the read. It's definitely worth the read. But basically what he's talking about is, you know, taking trades at key support resistance levels with defined risk. And by doing that, I think it really makes sense. I mean, intuitively, I've learned over the years that I'm usually trying to identify those key levels, and I'm usually trying to trade around those key levels too. Like, I want to see, is a level going to hold? Is it going to fail? And if it fails, you know, you look at where's the support below that level, and if it holds, you look at where's the resistance above that level, and you're generally looking for moves to that. Well, in that respect, I definitely agree, but reading it from somebody who's a successful trader and has put it into a concise explanation, it's really like, you know, a light bulb goes off. It's really an aha moment, and it helps solidify things that you already, you know, you kind of know, and you already look at, but you really haven't defined as clearly as something written on a book page. So that long explanation really just kind of boils down to the fact that, you know, I think that this is the level here, 12,652. 12,800 is also the level, but we need to see, it looks like we're not really getting any strength around this level, although we are holding. You can see these tails, these accumulation tails where the market, you can see especially here on the first couple of tests since this test, you can see it got accumulated up, then it probed below it, got accumulated up to that level. Here we were a lot of indecision, we were doji on the day, you know, back up to that level, a lot of indecision, back up to that level, but I think we closed more on weakness. We closed more on weakness on Friday than on strength. So what I'm looking at is, if this level doesn't hold, then I'm going to be looking to see a move back down to this level, which is about 150 ticks away in the Dow Futures. So this level will be the next level in play if we don't hold the 12,800 level, and then I want to see how it's going to act around that level. A failure of that level is really going to open up the door, in my opinion, to a fairly substantial move lower. So from a swing trading basis, what I'm looking at here, kind of putting it all together on this reversion to the mean type chart, is, you know, you've had the crossover of the 8 and the 21. This is a signal for many different type of moving average traders, where they're looking at this and they're saying, okay, you know what, I'm going to buy or I'm going to sell. You know, I'm going to sell a retest up here with the expectation it's going to push lower, and they're probably going to place, you know, if they're giving it a little bit of room, probably the stops will be placed above this swing high, right? So looking at that, that's probably where some of the bears have looked at, you know, initiating short positions and the logic behind those short positions. Now, if you look at some of the bigger players, they would probably be waiting for, you know, some of these levels to fail. I personally like looking, if I want to get on the short side, you know, you've had one, well, this is one major retest, two. If we get three, and then one of these, and then boom, and it comes through, then I'll be looking at a failure of that level, some kind of a retest. Or if it just kind of, you know, keeps doing this below that level, and it spends enough time, then I'll be looking at a possible failure there for a move lower. Now, in terms of targets, what I would probably do is I would probably project the distance between this area, almost like a Darvish squeeze or a Darvish box type trade. I'd be looking to project that lower. So that would be an initial target. It's similar to kind of like a point and figure approach, but it's really, you know, when I look at Darvish boxes, which we'll jump to in the next analysis, but what I would be doing is looking to project, you know, from this pivot point here to, you know, these highs, I'd be looking to project this entire range down in terms of a target. That would be an initial target. Then what I'd also look to do, is look at, okay, well, where's the major support? Well, you can see some support in and around this area, and then I'd be looking to see, look, do we have confluence between, you know, some of these projections in these areas? Well, if you look at this, you can see, you know, this was a resistance level, and you can see when it broke above it, you see this tail, how it came down and it retested it. Here's a good way to find a nice horizontal level. Okay, so I like that level just by looking at it by eye. And what we'll do is actually, you know, this is kind of how I develop some of these levels, so I thought I'd share it. So let's throw a line on here because this kind of scenario may be in play. Let's throw a horizontal line in here, and I want to grab it somewhere in here, you know, where you've got more of the price action. Here's a, you know, kind of a minor spike high, and then you've got, you know, these highs, and then when you see it gap through it, came down, retested it, came down, retested it somewhere in there. So it's not an exact science, but it's going to be somewhere around there. So let's make it a little bit thicker. I think this level might be in play as a potential target, and we'll just give it a different color. Let's give it a gray target so we know we've, you know, created that for a different reason. So if you look at that and then we run the math on this, you start saying to yourself, okay, 13,000. I'm just going to spend a little bit of time on this so that, you know, some of my members can get the logic of how, you know, how I look at these things. So we've got 13,242, right? 13,242, and then if we subtract 12,652, that gives us about 590 ticks. That's pretty substantial. 590 ticks, and then if we subtract that 12,652, right? 652 minus 590 ticks, that brings us down to 12,062, and you can see that's about 100 ticks away from that level there. So that level there, 12,000. Let's just put another line there, new parallel, and we'll just give it the same value there, just to get an idea of 12,062. So that puts us a little bit lower. So if you look at that level, we'll just give this a different color, just to denote that this is a this will be a potential target. We'll make it a little bit darker there. So, well, that doesn't really make much of a difference, does it? So let's just give it a color. Let's just make it let's make it white so it stands out. So now what you're looking at then is 12,062, 12,160. Those are potential targets that I would be looking at from this type of chart analysis. Okay, looking at a potential failure of this level. So if we do fail this level here, then I'd be looking at this as an initial target. Okay, so if I were going to swing trade this, and I'm not sure if I will yet, I'll definitely be day trading it, and I'll be looking at these levels. I'll definitely be looking at these levels for, okay, if it breaks this level, I'm going to be on the short side fairly heavily from a day trading basis. So what I'd be looking at then, a failure of this level, I'd be looking at, if I were going to swing trade, I'd be looking to take probably some profits at half the width of the box, or the range rather. So I'd be looking at this area probably as a T1, and then I'd be looking at this area as a T2, you know, as a second target or as an ultimate target. I mean, this is a pretty good move. And then I'd be looking at this level as a potential target 2 or target 3, depending on, you know, how large my position size was. So this would be kind of, you know, the short area, a clear break of this level. You know, you want a confirmation that it's going to break that level, not one of these situations where it's just going to come back through it and then, you know, push off, you know, where you get accumulation at that level. You want to see a break of it. So then if you look at that, that is a pretty decent scenario with these targets, you know, 12,160, 12,062. And then if you just, we'll leave those levels on the charts there looking into next week. But if you also, you know, look lower, I mean, I think those are really the immediate targets. I think that's really where you're going to find, you know, the immediate support. And I'm not sure that we'll really, you know, I wouldn't want to hazard a guess that we're going to come down and test these lows at that point in time. But that's really my game plan, looking at if we break those levels. Now, if we hold these levels, and we push back up, I don't think I'd really want to get swing long. At this point in time, I don't think I'd want to get swing long unless we broke through these highs cleanly. So if we broke through these highs and then came back down and tested and held those highs and pushed off, or looked like we were going to push off, then I'd be interested in getting back on the long side. But I think the risk in getting long and hoping one of these levels is going to hold at this point in time, from my perspective, from my opinion, it's too risky, because now you're really entering into a sideways phase, and the last thing you want to do is just get chopped up. You know what I mean? I don't like getting chopped up. I also don't like, you know, trying to short the high and buy the low, because at some point that's going to fail miserably. The market's going to decide where it wants to go, and when it does, it's probably going to move fairly quickly. So at this point in time, like I mentioned at the beginning of the video, and I apologize, I'm spending a lot of time on this, but I think it's an important concept. So this is the dead zone, and not from a day trading perspective, but a swing trading perspective. And I like shorts below this level, and I like longs above this level. Okay, so long, short, okay, but you need to see a fairly clean break, and you need to see some confirmation of that. And at this point in time, we're just really we're just in a kind of volatile sideways, very large sideways range. I mean, that is a pretty big range of what did we say, about 590 ticks. That's a pretty big range. It's you can catch good intraday trades and good intraday trends there, but from a swing trading basis, it's really just too risky. I hope that makes sense. Okay, let's take a look at the market from the Darvis squeeze perspective. So let's see what we have setting up here. We'll take a look at the weekly chart of the Dow Futures, and I'll just expand this chart out. And you know, you have this Darvis box in play, the same levels in play, and what you can see is, you know, you're holding the bottom of the Darvis box, you held the top of the Darvis box. So you just really need some direction out of that range. And you know, the analysis is really no different than the analysis we were talking about on the reversion to the mean type chart. But now what you're looking at here is, you know, this, you can see this is rolling over on the MACD, and you can see the MACD itself is rolling over. So we could potentially, you know, get a move below that level. So right now you can see you've got a bit of confluence there. You've got the 21 EMA on the weekly chart right around that level as well. So that you can see that is a key level. So you've got your 21 EMA on the weekly chart coming in around that same level. You know, of the breakdown, that's coming in with the weekly Darvis box too. And I think what you're looking at, you can tell here, you know, from a weekly basis, you've got your Hakinashis are rotating from red, blue, red, blue. Now we're on red. that's really, you know, you don't really see that often. If you look back, you see, you know, you'll get a rotation like this, a rotation like that. But when you see this, this is, to me, looks like a lot of indecision. It looks like kind of a tug of war between, you know, the bulls and the bears, and that's probably why you're getting, you know, talking to other traders. It's been a pretty tough couple of trading weeks, you know, for intraday traders, because I think you're getting a lot of volatility there. You're getting a lot of tug of war. You're getting some erratic price action. So, you know, you want to try and catch intraday trends that are going to be, you know, fairly smooth, so that you can grab some, you know, 10, 20, 30 ticks out of the moves without having, you know, herky-jerky price action. So these areas of consolidation and of these tug-of-war areas are always the hardest areas to trade, in my experience. The easier areas to trade are, you know, this is what I call the meat of the move, and I know some other traders do as well. This is like the meat of the move here. These are the easier areas to trade if you get on board and say, okay, we've got a trend in play, buy the pullbacks and ride the wave higher. Once you get into, you know, a lot of people counter trend these areas, but I think as you gain more experience as a trader and you recognize here's the trend and you're not trying to counter trend it, you just buy the pullbacks, right, in an up market. And these areas here, they're really harder to trade. They're tug of war areas, they're consolidation areas, they're areas of contention, whatever you want to call them. They're really harder to trade. Okay, let's take a look at the Dow from the Darvas squeeze perspective as well. Now we don't have, we've got a Darvas box in play. We don't have a squeeze in play, but what you have is you've got red Hakanashis. You had this, you know, the move from the high to the low, this high to the low, which is pretty close. I mean, I don't think it really needs to be adjusted. So from this high to this low, you know, you had a break above the 50% retracement, or the 618. Okay, I'm sorry. You had a break above the 50%, you had a break above the 618. Once we broke above the 618, you know, you want to see that 618 hold, which, you know, it came right, you know, you saw that confluence between the 61.8% from a Fibonacci perspective and the 21 EMA from the moving average perspective. So when we broke that level there, and then you can see we broke the 50% as well, what you can see there is, and depending on how you draw these Fibonacci's, these numbers can be reversed. So basically, if you looked at it from this low to that high, you could basically reverse the numbers. The 50 would be here, the 618 would be there. But the point is really the same, is that once you broke this lower zone, and you see you come up and you've been testing it, you haven't been able to get back above it. So this is an indication that of weakness in the market, and you really need to get back above this 13,020 level, at least to get another shot of a retest of these highs. So at this point in time, if we're going to stay long enough below this 12,949 level, I think what you're going to get is, you can see now the moving averages are starting to roll over. The 8s cross below the 21. So if you're going to, you know, you might see some of this, and then you might see it start to break down. Well, you have this Darvas box here, and if you got a squeeze come into play, so that you had a Darvas squeeze come into play in a break of this level, I'd probably use a break of these lows. I mean, they're fairly close. They're fairly close, and I wouldn't want to see it come down and bang, you know, and then just pop up. But, you know, this area, this zone in here, if you got a Darvas squeeze set up with a break of that area that we identified, you know, in the other analysis, looking at the other charts, then I would be really confident. I'd be really confident that we're going to get a decent move lower. So I'll be looking for that. I'll be looking for a potential Darvas squeeze to come into play, to give, you know, some, you know, to give me a heads up that there's going to be some fresh volatility and an actual break of the support level. You know, similar to like this, when you get a Darvas squeeze in play, you know, you break the support level, and you get a fairly, you know, quick move down to the target. So if that comes into play, I'll be watching that for, you know, that potential move lower. And of course, if it breaks to the high side, well, then that would be a go with as well. So, this is one of the reasons why I use the Darvish squeeze setup, because it makes the decision process a little bit less subjective, and it's kind of like, okay, look guys, here's your, the market's saying to you, look Dave, here's your resistance, here's your support. If I'm in a squeeze, I'm going to get a return to volatility. If I break a support or resistance level, that's where I'm going. Okay, so it makes it a little bit more subjective, less subjective rather, and just kind of like a no-brainer. Just go with it, don't fight it. So that's what I'll be looking at. I'd like to see a Darvish squeeze come into play to give it that, power, that confirmation that we're going to get some movement out of it one way or the other. So that's we're at a good point there. You can see can even see volumes kind of picking up a little bit here in this area, which kind of denotes to me that people might be intensifying their positions or taking bets one way or the other. We don't know exactly which way they're taking them, right? Because they could be buying support or they could be shorting those levels. So we don't know at this point in time. Now what we do have an indication that the MACD looks like it's rolling over, and it looks like it's rolling over below its zero line. Okay, so that is a good kind of piece of the puzzle. And then you can see our trending indicator starting to roll to the low side. So that is really a heads up to me. I'll be looking closely to see if this Darvish squeeze is going to come into play, and if it does, I'd be fairly confident at this point in time. I'd be confident to to either just go with it or wait for it to come up, do a kind of a bounce and take the second, either the first, or if it does give us an opportunity where it bounces and comes down, I'd look to take the second as a go with. Okay, the second breakthrough, that level as a go with, because sometimes you get people buying that and it pops up and you take some heat on the trade, where it can pop up to here, even as high as these levels, and then it will roll over, and then you can take the second as a go with. So depending on how aggressive you want to be with a trade like that, and I mean, I'm not making a recommendation. This is specifically, for educational purposes. This is how I would be looking at the market. This is what I'm specifically looking at. So that's what, this is always the safer, the go with on the second, but sometimes you don't get that. You just get, it'll break and it'll go. Sometimes you'll get, the retest, the bounce, and then the second is a go with. So that's really a decision you have to make at the time, based on your level of comfort, based on how aggressive you want to be with the trade, how confident you feel with the trade. Ultimately, you have to manage your risk and say, look, if I do that and I do short it here and it bounces on me, I need to place a stop somewhere, and normally I would place it around half the width of the box, or at just above the highs, depending on the total account risk I'd be looking at. So I realize this is really a little bit drawn out. We're about half an hour into the analysis and we haven't even finished with the Dow, but I think this is very telling for other markets, because I think other markets are really probably in similar situations as we'll look at as we move forward in this video. But they're also this is a pretty major this is going to be a pretty major move if it does happen, for the simple fact that we've really been in this area for a long time, and a move outside of that area would probably denote that we're going to get some good opportunities potentially and some real movement. So I think it's worth the time spent. This is what I'll be looking at. At this point in time. I think this is in play, but if it doesn't come to fruition and we actually get a Darvish squeeze and then we break the highs, well, that will make sense. If this starts rolling to the high side and we get a break of the highs, then then I'll be looking to potentially go with that as well. So I hope that makes sense, and I hope that helps. Okay, so let's have a look at the S&P futures. I'm not going to spend as much time on it, obviously, because if I do, we'll keep you here forever. But you can see that here's the weekly Darvish box on the S&P futures, and you can see it's kind of below that, but it's still holding the 21 EMA around the 1341 level. Now, if you look at the daily chart, which I will expand out here, if you look at the, I mean, this is really sloppy, right? And you normally see this with, you know, sideways markets. You know, they can get pretty ugly. So if you look at, you know, we had a Darvish squeeze short here, followed through, held support, moved higher. Then you had a Darvish squeeze to the long side here, and you see it didn't really follow through on the ES. The Dow retested its highs. You can see the ES didn't. What the ES did was kind of put in a lower high. Okay, so that is also telling. It put in this lower high here. This signal failed. Okay, that signal failed, and then the Hakinashis rotated back to red. Okay, you can see that here. And then what's happened is, you know, it's been spending a lot of time below its 21 EMA, okay, which is telling as well. And we've been finding support at this Darvish box here. And then you can see what's happening is now you've got a situation where, from this Darvish box perspective, let me just grab the pen again. From this would have been the last Darvish box in play at this level. It fired an intermediate short signal with a target of 1317. So let me just expand this so I can see what level that was. Geez, I can't even read it. Let's see, the Darvish box here from this level, which is somewhere around 1355. But you can see it's not a clean break, right? You've got all these accumulation tails. But what you would really want to see at this point in time is, I think now, because you have you're 3 days into a short squeeze, okay? So you're getting some volatility with some downside movement, and you can see that 1, 2, 3. If this broke through this level, this Darvish box here, fairly quickly around the 1340, 1341 level, okay? We'll call it 1340 to 41. If it breaks down below this level, I'd be looking for it to hit those targets a little bit lower at, what did we say there, 1317. Now this is an indicator that I wrote here that will print these targets automatically. I will be offering it on my website for people that are interested in it, because I do think it is a valuable piece of software. I use it a lot in my analysis. It's called, you know, if you've been listening to me for more than one video, you'll know it's called the Darvish squeeze. So this is the chart indicator for Darvish squeeze, and you know, it's set to use a 1-to-1 target. So it's looking at pushing this range out on a 1-to-1 basis down here. That's where it's deriving this potential target. Okay, so I think that, you know, if this comes into play and we break this level, then you're going to have a bona fide Darvish squeeze with a target of at least 1317, and I think that would be quite achievable. You've got other things coming into alignment here to support the short side argument. You know, you've got a little bit of pickup in volume here. You know, so these things are kind of coming into play, and I think that this is a possible scenario that could play out. So I'd be willing to probably go with that kind of situation at this point in time if we, you know, clearly break that support level. Okay, so let's jump over to some of the other markets like the Nasdaq to see what they're doing in the transports. Okay, so let's look at the, you know, we were talking about the Darvish squeeze indicator for the charts. Now I've also got the Darvish squeeze indicator for the radar screen, which is another indicator I'll be making available at markettradingconcepts.com in the near future. So you can see this is a great way just to scan the markets to see where they're at. You know, you can see the Nasdaq is telling me the daily chart. Each one of these cells is basically a chart, almost like a spreadsheet, and each one of these cells is almost, basically its own chart. So you've got 60-minute, daily, weekly. I like to use multiple time frame analysis, and you can see the daily chart fired a recent short breakout on the Darvish squeeze, right? So when you look at that, it's telling us it did that 4 bars ago, And if you look at the daily chart of the Nasdaq, it fired an initial short when it broke this Darvas box, and it has a potential target with a 1-to-1 basis projecting this out of 24.9575. Okay, so this looks interesting. Now we see that the Nasdaq has already kind of fired signals. The other indexes are looking weak. So I think this is a possibility. Now we're still kind of holding that support line, but what I would like to see is a kind of, once it starts following through, maybe just getting on board, drilling down to a lower time frame chart, and maybe taking a signal off of a 60-minute chart, 30-minute chart, 15-minute chart. But the only caution that I have in, one of the cautions that I have in this is that you can see at 25.79, you're still holding support on the weekly chart. This is a pretty massive support level, so at this point in time, I'd really like to see it break that level. Okay, I'd really like to see it break that level with a potential, you know, it coming back and potentially testing this breakout point on this weekly Darvas box. So you've got a couple things going for you and a couple things against you. So you've got support here. You got to be really cautious of that because weekly support trumps all other support. Okay, weekly support trumps all. It trumps daily support. It trumps 60-minute support. Support on higher time frames is just stronger support. Okay, so what you're looking at here is you're still against your weekly trend, but this is something that would take some time, you know, obviously to roll over. You've got the MACD is kind of confirming that it's rolling over. You've got one red Hakanashi on the weekly chart. You don't really have a lot on the weekly chart. In fact, this is just a normal pullback on your weekly chart. You know, so the expectation could be the first test of something like this, it could just push higher, right? So you have to be really, really careful here. If you do take a short, I think the stop out level, in order to be cautious on something like this, I mean, if you're willing to risk all the way back up to this swing high, then that would be, you know, the preferred stop out level, just to give it a little bit of room, just above this swing high. But I think if we break back above this bar, I think the move is over. So if we get a, let's say for example, if you were to take a short here and just expect that it's going to go lower, it's not uncommon for it to do one of these where it will come back and it will retrace to the 21 EMA and then potentially roll over. So you could look at maybe either waiting for that scenario or, you know, placing a stop above the 21 EMA or placing a stop above this candlestick here, this wide range bar here. Because I think if you get through the 21 EMA and you close above this candle, I think the move would be over. So the scenario would be that this would be more in play than this. Okay, so this is kind of a tricky trade because, you know, you've got weekly support, but you've got some pretty decent signals coming in on the daily charts. And, you know, for something like this to follow through, you know, you're looking for a decent target of, you know, you're looking for, you know, a decent target. A move from there to there would be a fairly decent target. So it's kind of a, you know, it's one of those situations in trading where you just got to make a decision, establish your risk, or just, you know, if you don't like it, just stay out. It's that simple. So that's the Nasdaq. The Nasdaq looks like it's kind of leading the move to the downside. If I haven't mentioned already, the other thing I like going for this trade is that this is a little bit sloppy, but if you look at the Nasdaq, you've got kind of this this situation where not only are the moving averages starting to roll over and you've got a valid sell side signal here, but you've got, let's say this is your here's your high. Oops. Here's your high, and now you've got a situation where you've put in a lower high. Okay, so if I'm usually going to take a position on the long side, I like to see, you know, a higher low put in place, you know, before I actually get on the long side. Well, now you have an early stage situation where you have a lower high in place on the opposite side of that. So, you know, that looks like it might want to, you know, at least head down and put in a lower low. So that's kind of the scenario that I'm looking at from a number of different perspectives. Hope that makes sense. I apologize for the long drawn out explanation, but I think it's a good learning opportunity to look at some of the things that you can look at from a swing trading basis and how to identify those kind of early stage. This would be like an early stage reversal, but it is a valid signal, and I think it's a worthwhile signal to look at with defined risk. With defined risk, I wouldn't want to really be short probably above this candlestick here anymore, and I definitely wouldn't want to be short above this swing high anymore. So that's kind of what I'm looking at. If you're looking at this, define your risk, know your uncle point, and live to trade another day. That's kind of what trading is about. Okay, let's take a look at the transports. So the transports have a situation where a Darvish squeeze, this long side Darvish squeeze failed. Okay, so we're in this kind of choppy range. But what I'm looking at is there was a failure of this trend line, this intermediate trend line, and now we've got a Darvish squeeze in play here, which could potentially fire to the short side. We've got, it crossing below the zero line. So you've got red Hakinashis, you're in a squeeze. Volume's really low here, but not too concerned about that at this point in time. Now you've got this crossing, the MACD's crossing below the zero line, and it's crossed down, and the trend has crossed to the low side. So then you also have a failure of this intermediate trend line where it's going sideways, and last week we were close to the kind of middle of the range, but what you have here is you see this bar that closed more than 50% off of its highs is a potential sign of weakness, and now we've got this Darvish squeeze in play, right, with the red Hakinashi and with the MACD rolling to the low side, but it's still against this major trend, which is to be expected on the weekly chart at this point in time. It would be an early stage kind of reversal. So I'd be looking for the transports. If they fired a Darvish squeeze short, would lend some credibility from a Dow theory perspective that that the transports are in alignment with the short side. So that's kind of what I'm looking at. I think at this point in time, I think the short side is starting to look like the path of least resistance, but we need a little bit more confirmation if we really want to jump on board. The Nasdaq is kind of leading the way. You don't have clear signals yet, or confirmation at least yet from the Dow transports, or from the transports rather. But you do have some indications that things are looking a little bit weak. I wouldn't be surprised to see a little bit of downside. But if we hold those major support levels and we push off to the high side, I'm going to be very cautious. In fact, I'm going to be cautious to the point where I'd want to see it break, retest before looking at any potential positions. So if the Nasdaq though were to just kind of fall off a cliff, then that would give more credibility to the short side at this point in time. So it's an interesting thing setting up in the stock index futures and the stock indexes in particular, or in general rather. It's kind of a tricky time too, because you haven't really broken weekly key support in any of the markets really. Well, let's take a look at the VIX for the heck of it. I mean, if you really look at the VIX, to me, what this looks like, this is kind of supporting our analysis. If you look at, here's the weekly chart, right? I'm going to draw an intermediate trend line here. Let's see. I'm going to draw an intermediate downtrend line. So it's kind of a sloppy one, a little bit sloppy from these sort of peak highs. Let's draw it red, and let's move it. So you can see this kind of action taking place where I'm going to try and fit 2 points there. It's kind of sloppy, but if you look at this is looking on the weekly chart like it wants to set up a Darvish squeeze reversal. Okay, now if you look at this, this is still negative, obviously on the weekly chart. It's early stage, but if you look at this, you know, you've got, it broke through the bottom of the Darvish box here, right? Broke through the bottom of the Darvish box, broke through the bottom of the Darvish box. Now what it looks like is happening is a minor higher low in place, okay, which I like to see. I'd like to see, if for the long side, I'd like to see this higher low in place to give it energy to push off. And you can see now it's probing above this weekly Darvish box here. So you've got blue Hakanashis, you've got squeeze coming into play, you have the MACD is a little bit overdone, rolling to the high side. Of course, it's against the trend, but you're losing momentum to the downside, which would denote, you know, that you're gaining momentum to the upside. So if you really look at this scenario, this kind of paints a picture that, you know, if you were to get a long signal in the VIX or a Darvish squeeze reversal in the VIX, would denote that, you know, that the stock indexes are going to push lower. So this is just kind of another piece of the puzzle here. Another way to kind of, you know, if you want to have a scorecard for, you know, if it looks more positive than negative, or if you have more, you know, pros versus cons in terms of which way you think something is going to go. This kind of piece of evidence here is starting to make me like the short side a little bit more and more, and it's putting the short side for the stock indexes more and more in putting my, you know, my bias more and more in that favor based on the evidence. I'd really want to see a Darvish squeeze take place here to the long side, which would denote, you know, downside for the stock indexes. Okay, so a Darvish squeeze to the long side in the VIX, it moves opposite the stock indexes, so it would denote some downside in the stock indexes. I like the way this is looking. It's obviously Darvish squeeze reversal pattern is a reversal pattern. Okay, so that would denote that it's very early stage, and that it is, you know, it would be like a reversal, a turning point. So it would be a riskier type of trade, okay, and a riskier type of bet. Okay, let's take a look at the bonds. So here we're looking at the 5-year, and I mean, we've been talking a lot about this in the market trading concepts trading room, me and some of the other members, and it's really this is really a crazy situation that we're in. I'm kind of the opinion that bonds are in a bubble, and that these kind of levels are unsustainable. But, you know, my opinion doesn't really matter, and you know, everybody has an opinion, but ultimately it doesn't really matter what our opinions are. Don't fight the market. I mean, what we're looking at here is, I definitely at this point in time would not want to be short bonds. We were talking a few weeks ago about, you know, we had some weakness in the bonds, and we liked it to the short side on a retracement. That retracement didn't hold, and the bonds resumed their uptrend to the high side, and at that point in time it was like, you know, don't fight it. So if you look at the 5-year, okay, over here on my Darvish squeeze for radar screen in TradeStation, what you're looking at is it fired a recent long breakout 2 bars ago on the weekly chart. Now, weekly signals, I give precedence to other signals, obviously. Now, what you have here is you've got blue Hakanashis, you've got the squeeze firing, the Darvish squeeze firing here with the break of this Darvish box, with a long signal at 124 and change. So the only thing I don't like about this is you've got a bit of a divergence here, obviously, in the MACD, right? You see the prices are going higher, but the MACD is going lower. So I also don't like that. To me, what that denotes is it really is caution, but it looks as though the MACD might want to roll over. Okay, now you've also got divergence in the momentum, for lack of a better description, momentum in my trending indicator. Okay, and so I'm cautious. I'm really cautious on bonds higher, but at the same time, I don't want to fight the price action. So I definitely, even though you've got some divergences there, I wouldn't want to be short, because you've got these massive, signals, these massive buy signals coming into play. And to me, what this looks like is this just looks like governments are just propping up the bond market to keep interest rates low. So as a smaller trader, do you really want to fight those kind of money forces? I would say probably not, unless you really want to go broke pretty fast. I mean, there's a saying that markets can stay, markets can stay irrational longer than a trader can stay solvent. So, with that in mind, I think it's true. If you're trying to trade this on the short side, and you're fighting these humongous forces here that don't really make a lot of sense, except to say that there's some big forces that want to keep interest rates really low, and by doing that, they're keeping bonds really high. I don't think you really want to fight that. You've got this massive divergence here. In my opinion, this is a massive divergence where you've got prices going higher and you've got these indications going lower. But I still wouldn't want to fight that unless you have a sell signal. You don't want to fight buy signals. If you get a sell signal in place, then it might make sense to just keep an eye on the bonds and see if they're going to fail at some point in time. I really don't know where this is going, but to me, it looks like it's, it just doesn't feel good. It doesn't feel good knowing that, these interest rates are so low. This is not really sustainable. I don't really feel good about this. I feel like bonds are in a bubble, and yet I wouldn't want to fight it at this point in time. But everything that's going on, to me, it looks like a mess. And it's hard for me to kind of put it into words, but it looks like a mess. If we look at the daily chart of the 5-year, what you can see is, you've got, you had this 1272 extension come into play that it hit, and it's just going higher and higher. So, that's a situation too where, you're breaking through these highs. You're slightly breaking through these highs going back here. If you want to be short these, I wouldn't fight this. At this point in time, I wouldn't fight this. Obviously, the government wants interest rates low. They want to keep interest rates low. I don't know if they can sustain this going into the future, for how long they can sustain this, but I guess it's really in the government's interest to keep interest rates low because they can service their debt. It really doesn't help anyone to have high interest rates. The question in my mind, and this is what I'm really having a hard time vocalizing, but we have something that happens from time to time. We see it, with the 1987 crash. Is it the 87 crash, the 89 crash? But you see it from time to time. They're called price shocks. So you get these price shocks every once in a while where, I think when things become unsustainable, something has to give, and you just get like huge, I call them rogue waves almost. They're almost like rogue waves where, you don't hear about them a lot, but that one rogue wave can sink a ship. They're like 100-foot waves that just sink these humongous ships. You hear about them from time to time. Well, it happens in the market too. They're called price shocks. So in my mind, the risk that I see is, it's obvious that the government wants to keep interest rates really low, and I believe they are intervening. You could call it interfering, manipulation, whatever you want to call it. They are in the markets and they are causing this action, in my opinion. These are really big forces. These are governmental forces, central bank type forces, whatever you want to call them. But the question in my mind is, can they sustain this, or are we going to get some kind of unforeseen event or unforeseen price shock that is just going to catch everybody off guard, and you're going to wake up tomorrow morning where you've got a situation that became unstable or unsustainable, that gets away from the forces that are trying to prop these markets up, and by the markets I mean the bond markets, to keep bonds high and interest rates low, and is something going to catch them off guard and just create a humongous, rogue wave or a humongous price shock, which we've seen in other markets happen from time to time, and just like all of a sudden you wake up and you've got this huge price shock that either is short-lived and from a trading perspective just decimates some of the larger funds that are on the wrong side of that price shock, or and creates like an 87 style crash situation in this market, or what some people call a black swan event. Or is it going to or is it going to be a situation where you wake up one day or after a weekend, something happens, a price shock situation, and you can never really foresee these coming, but where all of a sudden interest rates are really high, and a lot of people get stuck on the wrong side of that. Now, it's obvious it's not in the best interest of most people, and by people I mean government, and other forces out there. It's not in the best interest of homeowners to have high interest rates. It's not in the best interest of the economy. But the question becomes, when you try to artificially keep something at a certain level for so long, is something going to give that we're not seeing and going to cause one of these events that is just unavoidable, uncontrollable, and unpredictable? So I hope that makes sense. I'm really, really cautious here. And we've been having debates in the trading room about should you lock in interest rates? We've never seen interest rates go up that fast, so why are you worried about it? We've been having debates back and forth about what our thoughts are about interest rates. I tend to be in the camp that interest rates are so low right now that the risk isn't that they're going to go lower and you're going to miss a percentage point of better interest rates. I believe where the risk lies is that they could go much higher and you're going to get stuck in a situation where at some point you're paying higher interest rates. Now, my opinion is just my opinion. It's, you know what they say about opinions, everybody has one. But I look at where the upside surprise might be and where, the ultimate risk might be. And I look at it from the perspective of if you have, let's say, some longer term debt, I would at least like to be able to say, to the lending institution, look, if it goes beyond a certain level at any point in time, I'd like to be able to lock it in at a certain level and not just, I personally wouldn't want to risk long-term debt waking up one day and not being able to control higher interest rates, not having some kind of a backup plan. So at these levels, I'm comfortable locking in rates, for 5 to 7 years. That's just my opinion. But, because the interest rates are so low, to me, it doesn't really matter. That's not the risk. The risk is the upside surprise to me. That's my opinion. Other people have said, it just doesn't happen. We've never seen it. But, we haven't seen a lot of things in these markets, and, people still get caught off guard. So that's kind of the camp that I'm in. Whereas other people are like, look, they want you to lock in interest rates because obviously they're going to stay low and go low for a long time, and they want you to be paying a slightly higher rate. So at this point in time, I mean, it's really not in the bank's interest to have low interest rates if they're not able to make the spread, because they make their money on the differential between what they can get money for and what they can lend it out for. And when that spread becomes really, really low, it doesn't benefit them. Now, that said, it doesn't mean that they really necessarily have any control over that if the government is, the Federal Reserve, the government, whatever. I don't think the Federal Reserve is government at all. I think it's a, consortium of large banks. But, that said, we're really in a point in time where this is stuff that, we're kind of in uncharted waters and in uncharted territory. And I'm spending some time on this because I just kind of want to put the thought out there that these are really interesting times that we're living in, and that I'm going to be watching this stuff closely and looking for kind of unprecedented things, because I don't think we can really know what's going to happen here. I personally don't think it's sustainable, but the market can stay irrational for a very long period of time. If they don't want interest rates to go up, then we can just say, well, they didn't go up because they didn't want them to go up. But at the same time, I'm also cognizant that we could be, we could have some type of a black swan event or a price shock type of event that just causes some real major instability in the market, because there have been unsustainable forces, at work, and things might get away on them. So apologize for the long kind of rambling there, but I think these are really important things to look at and to keep an eye on, and to to understand what the implications might be going forward into the future. I'll be watching this stuff, and I'll be actually watching these kind of things for what I call systemic risk, because the markets can become dangerous places to have overnight risk at some points in time. And at this point in time, I personally feel more comfortable day trading the markets rather than swing trading them, because I think that there are some systemic risks in the market at this point in time, and I wouldn't want to be stuck in positions not being in cash and being able to control what's happening. I'd rather be on the sidelines if some kind of major event happens. So I hope that makes sense. Okay, let's look at the 10-year. The 10-year's in the same situation. It fired a Darvish squeeze long on the weekly chart, and it's got targets going to a 134. It had a long at 132, targets at 134. You've got the 1272 extension on the daily chart coming in, where it fired a minor Darvish long as well based on this box, and it already hit that target. You've got the 1618 extension at 133-ish. So you've got 133.28. So you've got almost 134. You've got a little bit more potential upside there, at least in the short term on the 10-year. But it's basically it's in the same situation as the 5-year, and then you've got this this MACD that looks like it wants to cross over on the 10-year. So you're basically looking at the same type of scenario. Okay, let's take a look at the 30-year. The 30 years, it's not in the middle of its range anymore. It's more towards the top of its Darvish box range. And, you've got indications coming into play that it wants to go higher. Okay, so you've got a potential Darvish squeeze situation here about to take place on the 30-year. You've got this kind of divergence happening here where prices look like they want to move higher, but the momentum on the indicators are going lower. So I'd be very cautious here. The daily looks to be about the same. This is kind of a goofy signal here because this was the Darvish box in play at the time, so it ended up firing long here, which was kind of hindsight, because the squeeze came into play here. The Darvish box that was in play was here. So the 30-year looks to be about the same as the 5 and the 10-year. Okay, let's take a look at Google. We'll look at a couple of stocks here. So if you look at Google from the weekly chart perspective, it's basically, it's basically in this huge range in here. It actually looks like a bit of a triangle forming, where you've got this this sort of triangle formation coming into play where the price is kind of tightening up. At the same time, you've got this this high, and then you've got this what looks like a lower high coming into play. But then at the same time, if this forms a higher low, it's you don't really know at this point in time. I don't think it is, but if this follows through below this level, it's going to be set to put in a lower low. Okay, so at this point in time, you do have a weekly squeeze that fired off initially to the short side. You're losing momentum here in some of your indications. On the daily chart, I think it makes more sense to look at the daily chart. You had this short fire ultimately hit this target, and you can see it found support right at its target, and that's oftentimes what I look at, for a move, that if it ultimately hits its 1-to-1, that we might find support at that at that target. And it did do that almost to, you can see it was very very close there, and it found support there. It pushed off. This almost looks like an intermediate lower high, but what I'm really looking for is now you're in a squeeze, looking for guidance outside of this Darvis box. I'd like to see which way this Darvis squeeze is going to fire. If it fires to the short side, that would kind of bode for our, you know, kind of looking at a little bit of weakness coming into this market, recognizing that we're at key weekly support. So if it fires to the high side, I wouldn't fight that either. So we're kind of at a bit of an inflection point here. You can see, you know, you can see the volume that came in here when we fired this initial short signal. So volume here is relatively low, or at least average. And I don't normally look at volume that way, but you know, it is a little bit telling. Now you've got some short-term strength in the MACD. You're losing a little bit of momentum here. I think you really need to see direction out of this Darvis box. You really need to see a Darvis squeeze fire either way to get a good indication on the daily chart of where Google's going to go. So at this point in time, this is the dead zone, and you know, I would look at where the Darvis squeeze is going to point us moving forward. Hope that makes sense. Let's take a quick look at Apple. Apple, I believe, when it, I think it posted earnings. Let's see, I think Apple posted earnings here when it gapped up, and you can see it kind of put in on its gap up. It kind of put in a lower high. You can see that on this chart, where here's the high, the highest high, and then it came down. And then, you know, you've got this gappy action. This looks like a lower high to me. So what I'm actually looking for here is, you know, to me it's holding Darvis box support on the weekly chart, but I think a move down to 530 to test its 21 EMA on the weekly chart makes sense. Now, you could get some intermediate support in here where the gap fill was. It did essentially fill this open gap in here. Okay? It essentially filled that open gap right in there. So you could potentially find support there, but I think what I'd be looking at is for completion of this type of pattern, where it does this and then it puts in a lower low. Okay, so you've got this this higher high, right, and then you put in a lower high, and then you put in a lower low, lower high. You know, you're going to put in a swing point low. That's what I'm really looking for there. I always confuse those terms, so I apologize. But basically, I'd be looking for, you know, it to come down here and to put in a swing point low somewhere down here. So you don't have a squeeze in play, but you do have this kind of action taking place here, where this is kind of rolled. Okay, recognizing that the Nasdaq is at key weekly support. So you'd really need some confirmation that it's going to do that. But I think at this point in time, the markets are looking a little bit weak to me, and unless, you know, I wouldn't just jump on this kind of a trade, but unless something were to turn this market around at this point in time, and it could just be the fact that, you know, they are at weekly support. You know, a lot of the stock index futures are at weekly support. So, but I think I'm kind of looking for a little bit of weakness to come in here, and I'd like to see if it's going to play out this scenario, or, you know, it could even potentially hold this area and push higher. So I think the path of least resistance, though, would be to look for some lower prices. I mean, that's what I'm really at this point looking for. Not willing to place any bets on it, but that's kind of where the preponderance of the evidence that I'm looking at is kind of leading me to lean towards. Now, I would keep an open mind here and not take any trades unless I had a valid signal, which at this point I really only have in the Nasdaq on the daily chart, but it really needs to break that weekly support. So I think you'd really need to see a little bit more in the way of the downside in order to get, you know, on board this stuff. So I'm kind of a cautious short at this point in time. Okay, recognizing that we need to break some key levels in order to get on the short side first. But to me, it's starting to look like the path of least resistance. That said, we could also just end up going into, you know, a sideways consolidation mode. But I think at this point in time, we've been sideways for quite a while, and I think what's going to happen is we're going to see some lower prices in the stock indexes and in stocks in general. So that's kind of where my bias, if you you know, if you said, okay, you need to be long or short, you don't have a choice, I think I'd be more comfortable getting on the short side at this point in time if I had to.